As expected, this has been a very broad session because the issues involved in, or rather the discussion so far has covered very broad topics. And before moving on to some questions from the floor, I wanted to give the opportunity to, especially the initial three speakers, but everyone else to react to at least some of the things that I got. So obviously I'm not exhausting here. We talked about regulation. I think there has been no denial that this has been quite a bit of an achievement. We've in terms of minimization of systemic risk, but there have been divergent opinions on whether it's too much, too little, does it curtail growth or not. This may be something that someone may want to come back on. We talked a lot about the change in business model that has to happen in terms of consolidation, especially the threats from digitization, and very important, very interesting quote, banking is necessary, but banks are not, so maybe there can be some more input on this. And of course, we also heard quite a bit about the problem of NPLs, which is particularly important for Greek banks, and what should be done. And we heard probably different opinions that maybe some of the bankers may want to respond, that we have a suggestion that perhaps the targets may not be reached. Perhaps the banks have the tools but are not acting yet. So on all these and maybe others, would any one of you would like to come up and yeah, okay, Mr. Hellwig.
Okay, I want to comment on the role of regulation, since you immediately after my presentation asked what about regulation and growth. I think first of all, I agree with Antimos that the regulators should not try to manage risks. But we do need the regulation in order to make sure that liability is there. Then, in terms of what do we mean by growth, I think there is a big confusion of language between the notion that if someone gives you money and you use this money to spend, that spending creates economic activity, and that means GDP is higher than it was a year earlier. That's not sustainable, as this country has experienced. If we talk about growth, we need to talk about sustainability. And the biggest decline in growth since the 30s was in the fourth quarter of 2008 because of a lack of regulation before. And anyone who says we must soften the regulation in order to engineer growth must come up with an explanation for how he or she is going to avoid a repetition of what we had. On the question of whether capital markets have the capacity to provide for this, first of all, if you take retentions, you don't have to go through capital markets. And there are lots of banks that could make retentions and don't. Secondly, if you have a bank make a rights offering and reinvest the proceeds in the market, overall, there is no flow of cash. You just have a rearrangement of titles. The incumbent shareholders will be hurt because we have a bias coming from that overhang. But after losses, it's the job of the incumbent shareholders to participate in those losses, rather than gamble on the option value of gambling for the future.
Mr. Thomopoulos now?
I am for regulation, but regulation existed even before the financial crisis of 2008. The point is that it was not applied, it was not implemented. Why? Because you did not have a culture of information passing through the different departments up, and the different departments like the risk management department and all the other departments which are controlling were put aside. There were a few people deciding. Nowadays, what you have, and in Greek banks I can say, but also foreign banks, you have a lot risk committees. You have that immediately when there is an alert, they move up the information to the executive board. So, and there is the culture to not to reach the risk and then move. You have risk alerts. And for me, it is regulation should be there, should be strict, but if you have regulation without implementation, it's bad. And what I want to say is that what was missing is implementation, effectiveness of supervisory and regulation. The other thing is I don't want over-regulation because, and over, you know, what it is, the regulators and the supervisors, if they go and manage individual risks and they give a weight, let's say, to one of the risks, 3, but might be a risk which you say, okay, is unimportant, but is a risk which might happen once every 20 years, but if it happens, can destroy the bank. And that's why it's not as such the figures that we put, the weights in the risk. What we have to do is to have the committees, to have the risks, to have the audits, so that everybody is aware, information passes on quickly, and everybody is feeling responsible that they have to act before they reach this risk.
Thank you. There was a little exchange between me and Martin Hellwig about the essence of banking union and how long will we have to wait for truly European banks to emerge. I fully understand, I fully agree with you, and I fully understand you or the quoted President of France in this context, but then this is an explanation why a country like Poland that has a choice decides not to rush to the banking union.
Let me, if you promise to be very, very, very brief on your questions or comments, we can take a couple of those and then come back to the panelists to finish up. So please, Lazaros, Mr. Panourias.
I will, a super brief comment, it's a super quick question. On Professor Belka's point about the capital markets union at Brexit, I do not see how Brexit could affect the current state of the capital markets union, as I think is proceeding at full speed with full commitment expressed by also Vice President Dobrovskis, who inherited the file. And I think from an institutional point of view, the commitment is fully there and is moving at full speed. And I think it's important to clarify because sometimes we tend a bit to overreact to certain events, which no matter how significant they are. And a quick question on the home bias point. How could potentially be avoided in the future or mitigated? Thank you.
Let's take some more questions, comments before we get to answer them. Anyone else who would like to contribute? Okay, so let me give the chance, of course, to you to answer that question, but also to any of the discussants who would like to say some more things in terms of what has been said or not said. This is the final chance, and this will be the end of the panel. But please, Mr. Valatsas.
Thank you very much for your question. On the question of home bias, the institutional framework is there. You have a European supervisory mechanism that can push countries to have, push the banks to have less reliance on their home countries. And just think about it. If you run a corporate loan book at a bank and 95% of your exposure is to a single issuer, you're going to end up in jail. If you think about it the same way, when you're managing your sovereign exposure, this is the same principle you should apply. 95% of your exposure should not be with a single issuer. It's a simple supervisory framework.
Thank you. Any more comments? Someone?
I think we are missing.
Yes, please.
I totally agree with what Dimitris just mentioned, and he has been the root cause for the demise of the Greek banking system. This first tier, kind of first direct link to the sovereign. But looking into the situation in the Greek banks, despite all the good work that's been put together by successive governments, the Bank of Greece, policy setters in Greece and abroad, and the bank management teams, still, the sheer size of the link, I think it lends itself to serious discussion between the policy setters. Just on the top of my head, I was thinking numbers. There is, as we speak, despite the massive write-down on our sovereign holdings, there must be close to 22 billion euros of direct sovereign holdings in the Greek banks' balance sheets. On top of that, there's a 17 billion euros exposure to tax credits, a promise by the state that has to be kept intact for the next 35 years to be fulfilled. And on top of that, there's a 42 billion euros of ELA, which is obviously a liability to the national competent authority before it's transposed into the euro system. Take that together, and I'm sure I'm missing other exposures, that's 80 billion euros. That's 2/3 of the country's deposit pool, so no bail-inable universe unless we wipe out the deposits. And this is close to 45% of the country's GDP. So let's sever that link. And by the way, until and unless we detoxify the Greek banks from this link, that 40-odd billion euros of ELA, or 60-70 billion euros of Eurosystem funding, or 100 billion euros of obligation of the target, will not be covered by any foolhardy depositor or foolhardy investor. So that's the issue at task. Beyond the wishful thinking of let's sever it, is how do we get to that point where we can really detoxify the European banking systems from years and years, decades of running parallel to the ministers of finance, to the social, political masters of the sovereigns.
I think, if I may, that you made a very good speech against Grexit.
So, oh yes, Mr. Hardouvelis. We wouldn't want to miss your
Just
comment.
one question to Professor Hellwig. I just wanted to hear your view about what may happen to the U.S. You mentioned that the U.S. regulators are a lot more conservative, but now we have a Trump administration that's actually seeking to fight regulation. Do you think this eventually, I mean, at least for large U.S. banks, this is something beneficial? And is this a potential threat to European banks in the future? How do you see it?
That's a big question. It's clear that the Republicans don't like DoddFrank. But there are parts of DoddFrank about which one can have doubts. For instance, I'm not convinced that the Volcker rule as implemented in DoddFrank makes much sense. I think the Consumer Financial Protection Agency does make sense, but is perhaps not central to banking regulation. If I look what I see written from Republicans, those two elements are the ones that raise most emotions. On capital, it's very strange. You have Republicans on the far right and Democrats on the far left, both of them saying banks should be much better capitalized. I mean, if you take something like the Brown-Vitter bill 2 years ago, calling for big banks to have 15% of total assets in equity. Total assets in the US is less than it would be in Europe, but even so, that would be quite a big increase. Mr. Witter is a Republican senator very far to the right. And among the Republicans in Congress who are active now, and who are active in this debate, you have had very contradictory statements on equity. So nobody knows. Now, the other feature which I think we must be aware of is that, and we see it in the current negotiations about quote-unquote Basel IV, we may be moving to a refragmentation of regulatory rules. The US have started this 2 or 3 years ago by introducing ring fencing for international banks active in the US. The European Union is in the process of responding. I actually see that process as proceeding, and I don't think it's a bad thing, because the legal uncertainties involved with cross-border resolution are a major element in too big to fail.
Last comment to Mr. Touré, and then we have to end.
Just maybe I wanted to add that I think it's not a threat as long as in the Eurozone the cost of funding is very low. But as soon as the cost of funding is starting to increase, don't you think that there is a risk that the large corporate will raise funding from the US market where they will get better conditions than in the Eurozone? Yes, I'm saying that don't you think that as soon as the cost of funding, the cost of raising money in the Eurozone is going to increase, don't you think that large corporate will be considering raising funding and borrowing from the US market where it might be more competitive?
Perhaps you will discuss this in private. Unfortunately, we have come to the end of our time allotment. I want to thank very much, first of all, our audience here for being so kind to us, and then, of course, to our panelists, and who have performed extremely well under very difficult circumstances. So thank you very much, and hopefully we will all be together next year here. Thank you.